two investors. Same brokerage. Same index fund. Same decade. Michael started investing in 2010. He was 27, had just read enough to understand that broad market index funds were the most reliable wealth-building vehicle available to ordinary people, and he committed to contributing $600 per month, regardless of what the market did. He held through corrections. He held through panics. He held through the breathless headlines that predicted collapse every 18 months. His strategy was simple enough to explain in one sentence and disciplined enough to execute through genuinely frightening periods. By the end of 2024, Michael had approximately $340,000 in his investment account. He had contributed roughly $108,000 of his own money over 14 years. The market had done the rest. He felt, with good reason, that he had figured out the fundamental truth about investing. Stay in. Hold. Don't react. Let the market do what markets do over time. His cousin, Thomas, watched Michael's approach from a distance for years and finally started investing seriously in 2019. He adopted the same strategy: broad index funds, consistent contributions, hold through volatility. He did everything right by the playbook that had worked so reliably for the previous decade. But Thomas started at a different point in a different environment. And now, in 2026, he is reading research from Goldman Sachs that says something he was not prepared for. Something that, if accurate, will make the next decade of investing look fundamentally different from the decade Michael navigated so successfully. Goldman Sachs is projecting that the S&P 500 will return approximately 3% annually over the next 10 years. Not 7%. Not 10%. 3%. Roughly the rate of inflation. Roughly the return of a treasury bond. Michael read this and felt curious. Thomas read this and felt something closer to alarm. The question both of them are asking, the question everyone who has built their retirement plan around historical equity returns should be asking, is not whether Goldman Sachs is right. It is what this projection means, where it comes from, and what, if anything, an ordinary investor should do differently if the next decade of market returns looks nothing like the last. Pause. Music fades in softly. This isn't about a bank's forecast. It's about understanding what Goldman Sachs is actually measuring, why their methodology produces a number that should concern anyone who is planning to retire in the next 10 to 15 years, and what the historical and current conditions mean for your specific financial decisions right now. I'm going to show you the real rules of what Goldman Sachs' 2026 warning actually says, why the number they're projecting is grounded in specific economic conditions rather than pessimism, what the range of likely outcomes means for different types of investors, and the specific actions that separate investors who will navigate this environment well from those who will be blindsided by it. These are the things financial media summarizes in a headline and then moves on from. The substance matters more than the summary. And understanding the substance will change how you see every investment decision you make in the next 5 years. Transition to core content. Rule 1. Goldman Sachs' 3% projection is not a prediction about a crash. It is a prediction about valuation, and understanding the difference is the most important thing you can take from this entire conversation. When most people hear a forecast of 3% annual returns, they imagine a market that is declining or stagnant, a period of economic difficulty producing poor investment outcomes. That is not what Goldman Sachs is projecting. Their projection is based on a specific and well-established relationship between the price you pay for a dollar of earnings and the return you receive over time. The S&P 500, as of their research publication, was trading at a Shiller-Cape ratio, the cyclically adjusted price-to-earnings ratio, of approximately 35 to 38. The historical average Cape ratio over the past century is approximately 17. At current valuation levels, the market has priced in a substantial amount of future growth. Goldman's model suggests that paying this much for a dollar of current earnings, historically, has corresponded with the subsequent decade producing annualized returns in the low single digits. This is not a prediction of collapse. It is a prediction of modest growth following a period of extraordinary growth. The difference is crucial. A crash requires a specific negative catalyst. Low returns following high valuations is simply what tends to happen mathematically when prices get far ahead of earnings. Here's the historical context that grounds this projection. The two other periods in modern history when the Shiller Cape approached current levels were 1929 and the late 1990s. The decade following 1929 produced deeply negative returns. The decade following 1999 also produced negative or near-zero real returns, the so-called lost decade for equities. Neither of those periods required a specific apocalyptic event. They were the mathematical consequence of prices that had moved far ahead of the underlying earnings growth that justifies them. Goldman is not saying the market is about to collapse. They are saying the market has already priced in so much optimism that the remaining return over the next decade is likely to be modest even if the economy performs reasonably well. Rule 2. The concentration of the S&P 500 in a small number of technology companies is the specific structural condition that makes Goldman's projection both more credible and more nuanced than headline coverage suggests. As of 2026, the 10 largest companies in the S&P 500 constitute approximately 35 to 38% of the index's total market capitalization. This level of concentration is historically unusual. In prior decades, the largest companies in the index represented a significantly smaller share of total market value, meaning the index's performance was distributed across a much broader set of businesses. The practical consequence of this concentration is that the S&P 500's performance over the next decade will be disproportionately determined by whether a handful of technology and AI-related companies continue to justify their current valuations. If they do, if the earnings growth embedded in current prices materializes, the index performs reasonably well. If they don't, if the AI revenue revolution takes longer than expected to translate into earnings, or if competitive dynamics compress margins, or if regulatory pressure alters the business models, the index underperforms even if the broader economy grows steadily. But here's what most people miss. Goldman's research distinguishes between the concentrated S&P 500 and an equal-weighted version of the same index. The equal-weighted S&P 500, which gives the same weighting to the 500th company as to the first, is projected to produce meaningfully better returns than the cap-weighted version over the same period. The returns are not equally distributed across the market. They are concentrated in the same companies where the risk is concentrated. This distinction matters for investors who believe they are diversified because they hold an S&P 500 index fund. They are more concentrated than they realize. And that concentration is both the source of the extraordinary returns of the past decade and the primary driver of the valuation concern that produces the modest return projection for the next one. Rule 3. The 3% projection has a wide range of uncertainty, and the distribution of outcomes matters as much as the central estimate for practical financial planning. Goldman Sachs research does not predict 3% as a certainty. It projects 3% as a central estimate with a significant range of probable outcomes. The upper end of their projection range approaches 7%. The lower end approaches -2%. Understanding this distribution, not just the headline number, is essential for making rational decisions in response to it. The central estimate of 3% is driven by the valuation framework described in Rule 1. The upside scenario of 6 to 7% assumes that AI-driven productivity gains materialize faster and more broadly than historical technology cycles would suggest, producing earnings growth that grows into the current valuations rather than requiring price declines to restore normal valuation levels. The downside scenario of -1 to 2% over the decade assumes that the earnings growth expected by current valuations fails to materialize through competitive dynamics, regulatory intervention, economic slowdown, or some combination, and that prices revert toward historical valuation norms. A reversion to a CAPE ratio of 25 from the current 35 to 38 would represent a price decline of approximately 25 to 35%, even with steady earnings growth continuing. The practical implication of the wide range is that abandoning equity investment in response to a 3% central estimate would be rational only if you believed the downside scenario was certain. It isn't. The upside scenario is also possible. The appropriate response to a wide range of outcomes is not to bet on one end or the other, but to structure your portfolio to be functional across the range, which is a different exercise than simply maximizing expected return in a single scenario. Rule 4. The investors most vulnerable to Goldman's projection are the ones who don't know they're vulnerable, and the specific profile of that investor is worth understanding clearly. The investors most directly exposed to the risk Goldman's research describes are not reckless speculators or recent market entrants who bought during obvious bubble conditions. They are ordinary, responsible, long-term investors who followed the conventional wisdom about index investing and have been rewarded so consistently by the past decade's returns that they haven't examined whether the conditions underlying those returns are still present. Specifically, the vulnerable investor profile is someone who is within 10 to 15 years of retirement, has a high equity allocation based on the returns of the past decade, has built their retirement income projections on historical average returns of 7 to 10%, and has not stress-tested their plan against a scenario of 3 to 5% annualized returns over their remaining accumulation period. Here's what that vulnerability looks like with specific numbers. A person at 52 with $400,000 in equity investments, planning to retire at 65 with $1 million. Built that plan on an assumption of approximately 7% annual returns from their current balance plus ongoing contributions. At 7%, their $400,000 grows to approximately $900,000 plus the compounded value of their contributions achievable. At 3%, the same $400,000 grows to approximately $590,000 plus significantly less contribution compounding, a gap of $300,000 to $400,000 relative to their plan. That person is not aware they are carrying this risk unless they have specifically modeled their retirement at lower return assumptions. Most people haven't. The past decade's returns made lower return assumptions seem unnecessarily pessimistic. Goldman's research suggests they may be the more realistic planning scenario. Rule 5. International diversification is the specific solution Goldman Sachs identifies, and most American investors have dramatically underweighted it for a decade in ways that may now reverse. Goldman's research does not suggest that global equities face the same valuation concerns as the U.S. market. European, emerging market, and other developed market equities are trading at significantly lower CAPE ratios than the S&P 500, in some cases less than half the U.S. valuation level, which implies meaningfully better return prospects over the same horizon even under pessimistic assumptions. Goldman's projected 10-year returns for non-U.S. developed markets are approximately 7 to 8%, more than double their U.S. projection. For emerging markets, the range is wider, but the central estimate is similarly higher than the U.S. projection. The average American investor holds approximately 80% of their equity allocation in U.S. stocks. The U.S. represents approximately 60% of global market capitalization. The overweight to U.S. equities is not irrational. The U.S. has been the world's best-performing major market for the past 15 years, and following performance is a natural human tendency. But chasing the best-performing market of the previous decade is not a reliable strategy for the next decade, particularly when the valuation premium of that market is as elevated as it currently is. But here's what most people miss. The decade of U.S. outperformance that led most American investors to dramatically overweight domestic equities was itself a reversion from a prior decade when international markets significantly outperformed the U.S. cycles exist. The conditions that drove U.S. outperformance, low interest rates, technology sector dominance, strong dollar, are not permanent features of the investment landscape. Goldman's research suggests those conditions are changing. Rule 6. Fixed income is no longer the guaranteed disappointment it was for the previous decade, and its role in portfolios has fundamentally changed in ways most investors haven't updated their thinking to reflect. For most of the 2010s, holding bonds was a financial penalty. Interest rates were near zero, bond yields were minimal, and every dollar in fixed income was a dollar not participating in an equity market that was compounding at remarkable rates. The rational response, which most financial advisors implemented, was to minimize bond allocation and maximize equity exposure. The interest rate environment has changed materially. As of 2026, high-quality short and intermediate-term government bonds are yielding 4 to 5% annually, a level not seen since before the financial crisis. At Goldman's projected U.S. equity return of 3%, a 5-year Treasury bond yielding 4.5% is not just a defensive position. It is a competitive return relative to equities with a fraction of the volatility. This inversion, where bonds potentially outperform equities on a risk-adjusted basis over a meaningful horizon, is exactly the environment where traditional asset allocation principles were designed to operate, but which has been absent for so long that most investors and many advisors have forgotten what it looks like in practice. The practical implication is that investors approaching retirement who have carried high equity allocations through the previous decade may find a meaningful fixed income allocation genuinely valuable rather than merely defensive. Not as a hedge against volatility, but as a competitive return source that doesn't carry the valuation risk embedded in current equity prices. Rule 7. Goldman's warning applies most severely to passive index investors, and the distinction between passive and active is more nuanced in this environment than in the previous decade. This rule requires careful framing because it is easily misread as an endorsement of active management, which the evidence does not broadly support. Goldman's concern is specifically about cap-weighted index fund exposure to the highly concentrated, highly valued top tier of the S&P 500. The research does not suggest that stock-picking fund managers will outperform. It suggests that certain systematic tilts toward smaller companies, toward value-priced companies, toward international markets may produce meaningfully better returns over the next decade than a simple S&P 500 cap-weighted index. Not because active management adds value, but because the underlying companies in those categories are trading at lower valuations. Factor investing, systematic exposure to value, size, quality, and other academically documented return drivers is not active management in the traditional sense. It is passive exposure to a different set of companies than the cap-weighted S&P 500. And those companies currently trade at meaningfully lower valuations than the large-cap technology companies that dominate the S&P 500. I'm not done yet. The equal-weighted S&P 500, which requires no individual stock selection, simply distributes exposure evenly across all 500 companies rather than concentrating it in the largest ones. Goldman's research suggests the equal-weighted version of the same index has a significantly better return profile over the next decade than the cap-weighted version. This is not active management. It is a structural choice about how to hold the same set of companies. Rule 8. The sequence of returns risk that Goldman's projection implies is specifically dangerous for anyone planning to retire in the next 10 years, and the specific mechanics of why deserve careful attention. We discussed sequence of returns risk in the context of retirement income in an earlier rule. Goldman's projection creates a specific version of this risk for people still in the accumulation phase, a risk that operates differently but is equally worth understanding. If the next decade produces the low or negative return scenario that Goldman's range includes, an investor who retires in year 8 of that period will retire after a decade of modest or negative equity returns, with a portfolio that is smaller than their plan assumed, into a withdrawal period that begins at the bottom of the valuation cycle rather than the top. The retirement that follows this sequence is the retirement that tends to work out, historically. Retiring at the end of a period of poor returns, when valuations have normalized to more reasonable levels, means your withdrawal years coincide with a subsequent period of potentially better returns as mean reversion works in your favor. The retirees who tend to struggle most are those who retire at the end of a great decade, withdraw from a portfolio that is highly valued, and then experience the correction during their early retirement years when the portfolio is at its peak and their withdrawals are largest. Michael, who started in 2010 and has 15 years of strong returns behind him, is in the position of potentially retiring near the end of a great decade. Thomas, who started in 2019 and may experience the next decade of modest returns during his accumulation phase, may paradoxically be better positioned to retire in the mid-2030s from a valuation standpoint. The market being discouraging for the next decade during your accumulation phase is not a catastrophe for long-term investors. It is an opportunity to accumulate more shares at lower or flat prices, the full value of which is only realized in the subsequent recovery. This is why Goldman's warning is more alarming for near-retirees than for younger investors. Rule 9. The savings rate response to Goldman's projection is more powerful than any investment strategy response, and almost nobody emphasizes this sufficiently. When financial projections shift, when expected returns move from 7% to 3%, most investors immediately focus on the investment strategy question. What should I hold? Should I change my allocation? Should I add international exposure? Should I tilt toward value? These are legitimate questions. But they miss the variable that matters most in the response to a low-return environment, your savings rate. Here is why. In a 7% return environment, a person contributing $12,000 per year for 20 years accumulates approximately $493,000. In a 3% return environment, the same contribution produces approximately $322,000, a shortfall of $171,000 relative to the 7% assumption. That shortfall sounds alarming until you calculate what it would take in additional savings to close it. To produce the same $493,000 in a 3% environment, the same investor needs to contribute approximately $18,000 per year instead of $12,000, an additional $6,000 per year, or $500 per month. In a low-return environment, your savings rate is the lever that replaces the market returns you're not receiving. Each additional dollar you save in a 3% environment is more valuable relative to market returns than the same dollar in a 7% environment. The practical response to Goldman's projection for most investors is not a complex portfolio restructuring. It is a straightforward savings rate increase and a retirement timeline review that honestly reflects lower return assumptions. The investors who will navigate this environment best are the ones who respond by saving more, not the ones who respond by predicting which assets will outperform. Rule 10. Goldman Sachs has been wrong before, and the specific history of their predictions is context that every consumer of their research should understand. This rule exists because the appropriate response to Goldman's projection is not panic, but it is also not dismissal. It requires calibrated skepticism applied to a serious research institution with a mixed but meaningful forecasting track record. Goldman Sachs has produced research that has proven broadly directionally correct on major macro themes. Their early analysis of the BRIC emerging market opportunity in the early 2000s proved prescient, and their concern about U.S. financial sector leverage before 2008 was not sufficiently heeded. They have also produced projections that proved materially wrong. Their projections for oil prices and commodity cycles in 2014 missed the subsequent collapse, and their equity market projections for specific years have at times been significantly off in both directions. The CAPE-based methodology underlying their current projection is not Goldman proprietary. It is a widely used and academically validated framework developed primarily by Nobel laureate Robert Shiller. The methodology correctly predicted the poor returns following the late 1990s CAPE peak. It did not specifically predict the timing of the 2000 decline, only the general return outlook over the subsequent decade. The 10-year forecast was broadly correct even when the year-to-year forecasting was not. The appropriate relationship with Goldman's projection is to treat it as meaningful input into long-term planning assumptions rather than a specific prediction of market performance in any given year. A reasonable response is to review your retirement projections using a range of return assumptions, including scenarios of 3 to 4% as well as the historical 7%, and to ensure your financial plan is not entirely dependent on historical returns continuing. Rule 11. The individual investor's advantage in a low-return environment is behavioral, and it is more valuable than any institutional advantage Goldman Sachs itself possesses. This is the rule that most financial media coverage of Goldman's warning completely omits. And it is the most important thing for an ordinary investor to understand. Goldman Sachs manages money for institutional clients with short-term performance mandates, regulatory constraints, career risk for managers who underperform benchmarks, and liquidity requirements that force selling at inopportune moments. Individual investors with long time horizons, no external performance mandate, and genuinely voluntary liquidity have a structural advantage that institutional investors cannot match: the ability to do nothing when nothing is the right thing to do. In a low-return environment where markets are volatile but the long-term direction remains positive, the primary driver of individual investor underperformance is behavioral: selling during corrections, moving to cash during uncertainty, chasing recent performance in ways that systematically buy high and sell low. The warning is real. The analysis behind it is credible. And the appropriate response is the same response that has always separated investors who build lasting wealth from investors who are perpetually surprised by an environment they didn't prepare for. Understand what you own, why you own it, and what you will do when the next decade looks different from the last one. Because it always does. OUTRO, measured, calm, deliberate. End card. If this video helped you understand Goldman's research in a way that financial headlines didn't, share it with one person who read the 3% headline and either dismissed it or panicked without understanding what it actually means. The next video in this series examines the specific portfolio adjustments that historically produce the best outcomes in low-return equity environments, not predictions, just structure.